From cars to computers, the U.S. imports billions in goods from Canada, China, and Mexico every year. But what's changed over the last 15 years? And how does America's trade deficit give it the upper hand in global negotiations? Let's explore the data behind the trends. The U.S. trade deficit, where imports exceed exports, can provide the country with significant leverage in trade negotiations. As a major buyer, the U.S. drives demand for goods and services from its trading partners, making these economies reliant on American consumers to sustain their exports. This dynamic gives the U.S. an upper hand in trade disputes or negotiations, because any reduction in imports from the U.S. could disproportionately impact the economies of surplus countries like China and Mexico, which depend heavily on exporting to the U.S. Additionally, trade deficits often reflect strong domestic demand and economic growth, positioning the U.S. as a critical player in global trade flows. However, persistent trade deficits can also pose drawbacks, such as increased reliance on foreign production, potential job losses in domestic